So you've got a couple with stock options, and they're getting divorced. The big question is, who pays the tax? This whole area can be an absolute financial minefield. Today we're going to do a deep dive, dissecting the really complex tax rules for dividing non-qualified stock options. And just a heads up, this is a technical session for professionals. We're going to get granular, talking specific IRS codes and rulings that govern these transactions, all to help you navigate this tricky area with a lot more confidence.
Okay, so here's our roadmap. It's pretty straightforward. We're going to start with the foundational legal conflict, the thing that stumped practitioners for years. Then we'll walk right through the IRS's two-part solution for both income and employment taxes. After that, we'll untangle the really complex reporting requirements that the solution created. And finally, we'll explore the riskiest edge cases. We're talking unvested and incentive stock options. By the time we're done, you are going to have a complete picture of this very intricate process.
You know, before 2002, practitioners were in a really tough spot. They were caught smack in the middle of a tug-of-war between two fundamental tax principles. And the outcome of this conflict? Well, it could seriously impact the financial well-being of one of the spouses, so it was a critical issue to get right.
On one side of the ring, you have the incredibly powerful provision of Internal Revenue Code Section 1041. Now, this section was specifically designed to treat a divorcing couple like a single economic unit. It lets them divide up property, cash, real estate, without triggering any immediate taxes. The person receiving the property just takes on the original owner's tax basis. It's a concept we call carryover basis. Simple enough, right?
But on the other side, we have this fundamental, deeply rooted principle, the assignment of income doctrine. It was famously laid out in the Lucas v. Earl case. And the principle is simple. You can't just give your paycheck to somebody else to dodge the tax on it. The person who earns the income is the one who has to pay the tax.
And this created a massive problem. See, a non-qualified stock option isn't just property, it's also a form of deferred compensation. So if the assignment of income doctrine won out, the employee's spouse could get stuck with the tax bill on the option's value, even if their ex-spouse got all the cash from exercising it. This was a potential financial disaster everyone was trying to avoid.
Well, thankfully, the IRS finally stepped in and gave everyone some much-needed clarity. They effectively ended that tug-of-war, at least for income tax purposes.
And here it is, Revenue Ruling 2002-22. This gave us the definitive answer. It explicitly says that Section 1041 is what governs the initial transfer of vested NQSOs. And let me tell you, this was a pivotal decision. It fundamentally shifted the entire tax landscape for these assets in a divorce.
So let's break this down. The crucial point is this. The initial transfer is totally tax-free, just like any other property under Section 1041. The assignment of income doctrine, forget about it. It gets set aside. And here's the critical part. The tax liability for the ordinary income that's recognized when the options are exercised, it shifts entirely to the ex-spouse, the one who receives and exercises the options. They basically step into the employee's shoes for income tax purposes.
But you know how it goes. You solve one problem, and another one pops up. Revenue Ruling 2002-22 was completely silent on employment taxes. We're talking Social Security and Medicare, FICA, and federal unemployment tax, FUTA. Who is on the hook for those? The IRS answered that question 2 years later with Revenue Ruling 2004-60. And what they created is what's known as a bifurcated system. It basically splits the tax liabilities in a very specific and, frankly, pretty unexpected way. Now take a good look at this, because this is where things get really interesting. On the left, you see the rule we just talked about. The ex-spouse, the transferee, pays the income tax. Simple. But look at the right. For employment tax purposes, that income is still considered wages of the original employee. So get this, the employee's spouse is on the hook for their share of FICA and FUTA taxes on income their ex-spouse just received. So, as you can probably imagine, this bifurcated system, with two different taxpayers for two different kinds of tax on the very same income event, it creates a very specific and often really tricky set of reporting requirements for everybody involved, the employer, the employee, and the ex-spouse. First up, the employer. They have to issue a W-2 to the employee's spouse. Now notice this, Box 1, which is for income tax wages, will be blank for this transaction. But Boxes 3 and 5 must include the income because it's subject to FICA taxes. This mismatch is then explained to the IRS by putting that same amount in Box 12 with Code V, which specifically flags it as income from the exercise of non-statutory stock options.
Okay, at the same time, the employer has to issue a Form 1099 MISC to the ex-spouse. Why? Because the ex-spouse isn't an employee, so a W-2 would be wrong. The full amount of ordinary income they got from the exercise gets reported in Box 3, Other Income. And if any federal income tax was withheld, which is pretty common, that goes in Box 4. Now, this is a huge point for the ex-spouse's tax preparer. The income from that 1099 MISC has to be reported on Schedule 1, Line 8, for Other Income. If you mess up and put it on Line 1 for wages, the IRS computers won't find a W-2 to match it, and they'll spit out a mismatch notice. But even more importantly, putting it on Line 8 makes sure that self-employment tax isn't assessed, because remember, the FICA taxes were already handled on the employee spouse's W-2.
Okay, so while the rules for vested NQSOs are pretty clear now, the guidance carves out some really important exceptions and, honestly, leaves a lot of ambiguity in other areas.
This is exactly where all that clear guidance we just talked about starts to get, well, blurry. All the rules we've covered apply specifically to options that are already vested when they're transferred. But what happens when they're not?
And this quote right here, this highlights the problem perfectly. Revenue Ruling 2002-22 has this explicit carve-out. A substantial contingency is just tax speak for not being vested. So this exclusion from the ruling's safe harbor, it opens the door to the exact risk we saw in cases like Kochansky, where the assignment of income doctrine could still apply and potentially make the employee spouse liable for the income tax. After all, it's a big risk.
Okay, another really important thing to consider: incentive stock options, or ISOs. These are what we call statutory options because all their special tax benefits are laid out right there in the tax code. But one of their strictest requirements under IRC Section 422 is that they are not transferable, period. A transfer in a divorce violates that rule. So the moment an ISO is transferred, it's disqualified. It automatically converts into a less favorable NQSO. And poof, all those bifurcated tax rules we just discussed suddenly apply.
All right. That was a lot of technical detail, so let's bring all of these different threads together into a really clear, actionable summary that consolidates all this complex information.
This table pretty much summarizes the tax treatment for the three main scenarios. For vested NQSOs, the path is crystal clear. Non-taxable transfer, income tax goes to the transferee, FICA tax goes to the transferor. For ISOs, the transfer itself converts them into NQSOs, and then they follow that exact same path. But I really want you to look at that big, bold, ambiguous for unvested options. That right there remains the key risk area for practitioners.
And you can think of this reporting matrix as your roadmap for making sure you stay in compliance. Follow these vectors precisely. The W-2 for the employee has to show the FICA wages but no income wages, all explained by Code V. The 1099 MISC for the ex-spouse shows the other income. And critically, that ex-spouse reports it on Schedule 1, Line 8. That's how you avoid those dreaded IRS notices and any incorrect self-employment tax assessments.
Ultimately, what this deep dive really shows is that a marital settlement agreement can't just say that stock options are being transferred. It's not enough. They have to be drafted with very specific language that accounts for these complex and bifurcated tax rules. You have to explicitly assign responsibility for the income tax and address that FICA tax liability. This kind of foresight can protect both parties from some very expensive and very unexpected tax bills down the road. The key takeaway? When it comes to stock options in a divorce, the devil is absolutely in the details.